Most people pick rupees 1 crore because it sounds like the ideal number. But here's what I actually want to ask you today. Are you 25 and single, just started your first job, or newly married and thinking about starting a family? Or you are a freelancer with no fixed salary? Do you have aging parents depending on you? So today, we are answering that one question I get asked the most. How much term insurance cover do you actually need in India? Because the answer to how much cover do I need is completely different for each of these people. And if you have been given one generic number, you have been given the wrong answer. I'm going to help you assess your life as it is and show you a formula that works for you. But for that, you'll have to stay with me till the end. No, it's not the 10x formula. That belongs to a time when earners had similar financial goals. One income, one home loan, 2 kids, retired 60. Today, a 25-year-old with no dependents and student loan repayments has completely different insurance needs from a 45-year-old whose parents live with them and depend entirely on their income. A self-employed business owner whose income fluctuates between 5 lakhs to 25 lakhs in a year can't apply a fixed salary multiplier. There's no fixed salary. And a newly married couple, where both partners earn, they need to plan for 2 incomes, not 1. The 10x rule gives you a starting point, but I have something better, DINK. The DINK formula is a globally recognized financial planning framework adapted here for Indian income replacement. 4 letters, 4 boxes. You fill your own numbers. So, grab a pen and paper. D, debt. D is for debt. All your outstanding loans, personal loan, car loan, credit card dues, everything except your home loan. That gets its own box. Add up every liability your family would be stuck with it if you weren't here. I, income replacement. I is for income replacement. How many years does your family need your income to continue? A simple approach. Number of years until your youngest dependent becomes financially independent. Multiply that by your annual income. If you earn rupees 10 lakhs and have 20 years until your child can fend for themselves, that's rupees 2 crore just for your income replacement. For self-employed folks, use your average income over the last 3 years. Don't use your best year or your worst year. M, mortgage. M is for mortgage, the outstanding principal on your home loan. We separate this from general debt because your home is an asset your family lives in. If this gets cleared on day 1, they keep the roof, so it needs its own dedicated box. E, education. E is for education. The future cost of your children's education, not today's cost. Education inflation in India runs at 10 to 12% per year. According to SOCAM estimates, a 15 lakh rupees degree today costs 47 lakhs in 12 years. Use a multiplier of 1.10 to the power of years remaining. No kids? This box is 0, which is completely fine. And it's one of the reasons why a 25-year-old single professional needs far less cover than a 35-year-old parent. Formula summary. DINK formula. Your cover is equals to D plus I plus M plus E. D, all outstanding debts excluding home loan. I is equals to annual income multiplied by years until youngest dependent is self-sufficient. M is equals to outstanding home loan principal. E is equals to future of children's education, inflation adjusted. Then, subtract liquid savings and existing life insurance already in force. Add 20 to 25% inflation buffer on the final number. Let's say you're 25 to 30 years old, single, salaried employee, earning close to 7 to 10 lakhs a year. You may or may not have an ongoing education loan. You live on rent, no spouse, no kids, parents are healthy and financially independent. You might think, why do I even need a life insurance? I have no one depending on me. 2 reasons you need a term insurance cover now. First, your education loan or EMIs. If something unexpected happens, that liability doesn't vanish. It could fall on his parents or be written off. But it's a real financial stress. Second, and this is the big one, at this age, you can get rupees 1 crore life cover for much cheaper price. If you wait until 35 to buy the same cover, that premium nearly doubles. Buying early saves you a lot of money. Quick DINK calculation. Debt, rupees 3 lakh. Income replacement, no dependents. So, we use a 5-year buffer as a safety net. Rupees 35 lakh. no mortgage, no education costs, you need around rupees 40 to 50 lakhs of cover. Get 75 lakh rupees. The incremental premium cost to go from 50 lakh to 75 lakh is almost nothing at this age. Say you are a married couple, no kids yet. You both earn a total amount of rupees 25 to 30 lakhs. You either have a home loan or plan to take one. Let's assume a home loan of rupees 60 lakhs. Here's a critical mistake newly married couples make. They insure only the higher earner. But their entire financial life, the EMI, the rent, the lifestyle is built on two incomes. If either one of them is gone, the other can't service the home loan alone. Both need cover separately. Let's calculate your dying. No extra debt, income replacement for 25 years at rupees 12 lakh is equals to 3 crore. Mortgage 60 lakh. No education costs here, but you should factor in rupees 40 lakh for one future child's education in case you're planning. Total rupees 4 crore. Offset existing savings of rupees 8 lakh. You need approximately 3.5 to 4 crore cover. Follow a similar calculation for your partner. Rupees 2.5 to 3 crores. Together, you're a dual protection household. And here's the thing. Buying this level of cover at 29, 28 costs a fraction of what it would at 38. If you're married with 2 kids and along with your spouse, you draw rupees 40 to 45 lakhs per annum, you might have an active life insurance plan, or you have considered purchasing one. Let's do a quick dime if you don't already have one. Debt rupees 5 lakh, considering you have a personal loan or car loan. Income replacement 20 years at rupees 30 lakh is equals to rupees 6 crores. Suppose you have an outstanding mortgage of rupees 55 lakhs. Education for 2 kids, future costs approximately 50 lakh to 55 lakh respectively. Total need rupees 7.1 crore. Offset rupees 25 lakh in liquid savings and rupees 1 crore from your existing policy. So you need approximately rupees 6 crore cover. Now, if your existing plan only has rupees 1 crore cover, you are clearly underinsured by rupees 5 crore. This is the danger of buying a policy early and never revisiting it. Your income has grown, loan has grown, had a second child. Your life moved, but life cover didn't. This is why you must review your life insurance plan every 3 to 5 years. Say you are a freelancer or run a small business. Some years you probably earn rupees 30 lakhs, but last year it was rupees 18 lakhs. You have a rupees 25 lakh business loan or 30 lakh home loan and live with your spouse and kid. Now, people like you are the most underinsured category in India. Partly because income fluctuations and partly because you don't know how to calculate how much cover would be enough for you. The answer is simple. Use your average declared income over the last 3 ITR filings. Let's assume it's rupees 22 lakhs. Here's a dime calculation. Debt. Business loan rupees 25 lakhs plus personal loans rupees 3 lakhs is equals to rupees 28 lakhs. Income replacement 20 years at rupees 22 lakh average is equals to rupees 4.4 crore. Mortgage rupees 30 lakh. Education for one child, future cost of rupees 40 lakh. If you have 2 kids, then double the future cost. Total rupees 5 crore. Offset liquid savings rupees 20 lakh. You need approximately 5 crore cover. Got existing policy? Review it as per your dime calculation. For you, a critical illness rider is also worth serious consideration. Scenario like yours is increasingly common in India and almost entirely overlooked in term insurance conversations. Suppose you're 40 years or older and earn rupees 50 lakhs a year, married and have 2 teenage kids and retired parents living with you. In your case, dependents span 3 generations. Your kids need education funding, your parents need ongoing living expenses and healthcare for potentially 15 to 20 years. Dime calculation is easy. Debt rupees 4 lakh. Income replacement 15 years until younger child is independent at rupees 18 lakh is equals to rupees 2.7 crore. No outstanding mortgage. Education for 2 kids rupees 35 lakhs and 40 lakh is equals to 75 lakhs. But then parents dependency corpus. You need to estimate approximately rupees 1.5 crore to cover their living and medical expenses for 15 years, inflation adjusted. Total cover you'd need is approximately rupees 5 crore. Existing savings rupees 25 lakhs. You also need a critical illness rider. At 45, the probability of a serious health event in the next 15 years is not negligible. Here's a snapshot. Take a screenshot if you want to revisit your life assessment later. Once you have your DINK number. 3 final adjustments before you finalize your cover. Adjustment 1. Add an inflation buffer. Rupees 1 crore today is worth roughly 55 lakh rupees in purchasing power in 10 years at 6% inflation. Whatever number the DINK formula gives you, add 20 to 25% on top as an inflation buffer. This costs very little at the time of purchase, and it means your family's cover keeps pace with the economy. Adjustment 2. Review your cover every 3 to 5 years. Life changes, your cover should too. Set a calendar reminder. Every 3 years, run the DINK formula again. What was right at 30 is almost certainly not right at 38. Adjustment 3. Consider critical illness rider. Here's the scenario most people don't plan for. You survive a serious illness. God forbid, a cardiac event, a cancer diagnosis, a stroke. You need 6 to 18 months of recovery period during which you take a career break. Medical costs alone could be rupees 20 lakh to 50 lakhs. A critical illness rider pays out a lump sum on diagnosis. This is especially relevant for the self-employed business owner, freelancers, and those who have 3 generations of dependents to take care of. Before I wrap up, here are 3 questions I get asked. What is the minimum term cover I need as a salaried employee? Even with no dependents, a minimum of rupees 50 lakhs to rupees 75 lakhs is recommended. Enough to cover any outstanding loans and give your family a 5-year income buffer. The earlier you buy, the cheaper the premium. How do I calculate term insurance if I'm self-employed? Use your average declared income from the last 3 ITR filings as your income figure in the DINK formula. Do not use your best year or your worst year. For term insurance for self-employed, also factor in business loans separately under the D, that column. Should I buy term insurance at 25 even with no dependents? Yes. And this is one of the smartest financial moves you can make at 25. This time, premiums are at their lowest. The same rupees 1 crore cover that costs around rupees 6,000 per year at 25 can cost nearly double at 35. You lock in a low premium for the entire policy term when you buy young. Hit the like button if this helped. It takes 1 second and helps other people find this video when they are asking the same questions. And subscribe if you want to keep getting content like this. And if you want to take this a step further, I've left something from Aditya Birla Sun Life Insurance in the description. You can explore it at your own pace.